Good evening. Welcome to another wonderful Rock Center event. I'm going to say the least important thing first because otherwise I'll forget. I'm going to put this microphone back into the stand when we get to the question part because the event is recorded. If you walk up to the microphone or ask for it when you ask questions, it'll work better. I'm Ron Gilson. I'm on the faculty here. I have the distinct honor of introducing tonight someone I've known for an awfully long time. We went to law school together, so it dates us both. Bob Pozen is going to talk about the title of the article, "Curbing Short-Termism in America." Now, this is either the subject is either the most current or the oldest story in history. So some of us who go back will recall that, roll us back to the mid-1980s. And a very impressive fellow, Michael Porter at the Harvard Business School, did some, at least, I was going to say some important, but at least some very interesting work urging that the United States capital market was radically short-term, and we would do a lot better if we restructured our capital markets to provide the same kind of incentives toward long-term investment that Germany and Japan had. You remember the mid-'80s was the center of the bust-up takeover movement in which people who then were called raiders, now some of them have lived long enough to be activists, were breaking up proud old companies. We see the same debate largely repeating itself now, that the structure of our capital markets are pushing companies to manage in the short run at the expense of growth, employment, public morality, wherever you want to take it. The debate is important. The debate takes precision because of the financial crisis. Having Bob Pozen here to talk about it is a particularly important opportunity. Bob's own career involves the long-term, short-term set of issues along two different dimensions. On the one hand, he ran two of the most significant institutional investors and private and asset managers in the country, and that does two different things. On the one hand, he's got the problem of setting compensation for a bunch of portfolio managers who understand incentives and understand trading for incentives. So it is a difficult and sophisticated process. At the same time, he focused on the incentive structure for the asset manager that he was running vis-a-vis their public funds. And then, just to keep to add the third part to the trifecta, the asset manager is making decisions about how to vote their shares in a market in which roughly 70% of the largest 1,000 corporations in the U.S. are held by institutional investors. So what we have Bob being on all three sides, not of the issue, but all three sides of the way the problem presents itself directly. It's a great pleasure to welcome Bob to Stanford.
Thank you. I assume everyone can hear me pretty well. So thanks for that nice introduction. And I want to thank Ron and Joe Grundfest for arranging this talk. And I want to thank Evan for doing the dirty work, actually getting it organized in a short amount of time. So I wrote this paper in response to what has become a flood of criticisms of short-termism. I mean, one always expects this from the business roundtable, from various corporate people, but lately it's come from so many different aspects of the society that I find it incredible. Leo Strine, the head of the Supreme Court in Delaware, wrote an article recently against short-termism. And Richard Branson, that very incisive corporate thinker, came out and is starting some sort of group against short-termism. And I know you all followed this, but the Prince of Wales himself has come out against short-termism in business. So when a person like me, being a natural cynic, sees so many people coming out against short-termism, you have to think, what exactly is happening here? And if you look, it's sort of unclear what they mean by short-termism and what they mean by long-termism. And we could have a debate about that. But I'm going to say to define short-termism is judging a company by its quarterly results, which is probably as good a definition as others. The interesting thing is, what's the long term? As we all know, Keynes said, in the long term, we're all dead, so that's a little long. But I would suggest that in today's financial world, the long term, I'm going to really stretch here, is probably no longer than 5 years, and maybe even a little shorter than 5 years. So what I was trying to do in this paper is try to analyze the various arguments to see how well they would stand up, and then look at their proposals, and then try to come up with some other proposals myself. So I'm going to talk here, and there'll be plenty of time for questions, in 5 parts. First, I'm going to start with the analysis of what is considered to be the trading problem, the big increase in trading volume. Then second of all, I'm going to talk about activist hedge funds, which are viewed by many people as the catalyst for short-termism. Then third, I'll talk about some of the proposals that the critics of short-termism have put forward. Fourth, I'll talk about executive compensation, which I think should be more of a focus in this debate. And lastly, I'll talk about what are called projections of quarterly earnings and about how companies get various shareholder bases. So let's begin with the question of short-term trading volume. The statistics here are very clear. Over the last 20 years, the daily trading volume on the New York Stock Exchange or any other stock exchange has gone way up. I mean by double, triple, quadruple, depending on what statistics you use. The question is, what do we make of it? There are lots of sentences in these various critiques that sort of say the trading volume went up and also short-termism went up, as if there's a causal correlation. But it seems to me it's really flawed, because when you analyze why it is that the trading volume went up so much, it's because we have a group of people who trade like banshees within the day. And these are, a good example is Michael Lewis's recent book on high-frequency traders. But we have huge amounts of volume being traded every day by people whose total time span is in the minutes, if not in the microseconds. So that, of course, leads to a much bigger average trading volume. But the question is it significant for corporate decision-making? And my answer is clearly no. These people who are trading, they don't care what the corporation's business plans are. They don't care anything about the fundamentals of the company. The only thing they care about is, well, there's a slight anomaly between the price on the New York Stock Exchange and the price in BATS or the price in some other market that they can arbitrage in a few seconds, if not microseconds. So the facts are right here that there's been a big increase in trading volume. But to me, the implication that this is something that drives corporate decision-making just seems to me a very weak argument. Now, the second big area where critics focus is activist hedge funds. And activist hedge funds are basically people who have some amounts of capital, who are trying to lobby companies to make certain changes. And the two most typical changes are, one is to pay more dividends, and the other is to sell or spin off a particular division that is unprofitable. So the typical argument is that these activists are basically quick buck artists who are trying to quickly get a company to do something that's going to increase its earnings, stock price is going to go up, and they're going to sell out right away. And so if that were true, we ought to find evidence of this. And there have been a lot of studies about this, empirical studies, and it won't surprise you to find out that some hedge funds move very quickly and other hedge funds stay around for a long time. I recently met with Carl Icahn, one of these activist hedge funds, and he showed me his average holding period and all this. And his average holding period is actually 4 or 5 years. So even though he's considered in or out, that's not true. And if we look on average, we see that the average holding period for activists is about 1 to 2 years. And the other thing that's true is that when they make these changes, they usually are pro-shareholders. Now, the question is, how do they get these changes made? Most activist hedge funds start off with 1%, 2%, maybe 3 or 4%. And in the end, they have to persuade institutional investors. And this is Ron Gilson's point, which he's made in a number of different articles, that in order for hedge funds to be successful in getting these campaigns to change either corporate strategy or corporate leadership, they have to get the majority of institutional investors who own, as Ron said, 70% of the stock. And I've run 2 large institutional investors, and I can tell you that people who are analysts at these places look very carefully at companies' track records, at companies' business plans, at the financials. And again, it won't surprise you to come to the conclusion that analysts think some companies are really good at long-term expenditures and other companies aren't. And give you 2 examples are Amgen's a company which has a high PE and people are willing to invest in, even though it spends a lot of its money on long-term biotech research. And it's proved to be good. On the other hand, you had here in California, HP's history, where you had the alleged plan of buying Compact and doing all sorts of great things. A lot of institutional investors didn't think it made sense, and it turns out that it did not make sense. And so you can't get away from the basic truth is that some companies are good at long-term investments and others aren't. And it can't be true that people, generally investors, are for short-termism, because why are they buying all these IPOs with companies that have no profits at all? Presumably they think there'll be revenues, they'll turn those revenues into profits, and they'll go that way. So if you look at the evidence for activist hedge funds, they win about 50% of the time, and they lose about 50% of the time. And that, I think, is probably the best evidence to say that, you know, institutional investors are very discriminating. Institutional investors supported and do support companies, a lot of biotech companies, but a good example is that they did support Carl Icahn when he lobbied Apple for an increase in dividends. They had a huge cash hoard, and they supported him in getting a dividend for Apple. Now, you could say that Apple then lost some capital that could have been used for long-term investments. It's true, but it had a huge amount of capital, and the question really is the incremental amount that went to dividends, was there really a better use inside the company? And I think I happen to agree with the institutional investors who thought it was reasonable to have them pay a dividend. And last thing about activist hedge funds is that there are studies, probably the most comprehensive one was by McKinsey, which looked at 400 activist proxy fights over the last decade, and they found that on average, the companies that were the targets of activist campaigns were on the decline when those campaigns began, and they increased on average substantially above the stock price of their peers, and that increase wasn't just a fleeting increase, it held for roughly 3 years. Some people have said that the performance went further, but I think it's fair to say that these quote-unquote improvements, if they are instituted because the activists do hang on for a while. So, therefore, I guess I would say that the two biggest arguments about short-termism are the first one on trading is just a non sequitur, and the second one is mixed. That is, that there are hedge funds that are helpful to companies and there are hedge funds that aren't. So the third point is what's the remedy here? And probably the most vocal critic of short-termism and activist hedge funds is Marty Lipton, who represents as a lawyer many of these people, many of the companies, and his proposal is for a 5-year term for corporate directors. And there are other proposals for 3-year terms, and basically, in my view, this is overkill. Because if you have a 5-year or a 3-year term for corporate directors, and you have a poison pill, and every company is able, under today's legal environment, to issue a poison pill, pretty much even after the takeover begins, the combination of having a 3-year term plus a poison pill makes it extremely hard, if not impossible, for a bidder to take over a company, even if it has been a chronic underperformer. So I think there are a whole series of these proposals that I see as sort of anti-takeover proposals in thin disguise. But there are other proposals that I think make sense. And one of them is a Marty Lipton proposal that says we now say under Section 13D, like David, of the Securities Exchange Act, that after an investor passes the 5% threshold for voting stock, we allow the reporting to be delayed for 10 days. And I personally believe that's too long in today's environment, and that we should ask these people to file their 13Ds sooner. Another proposal that I agree with is there is this phenomenon called empty voting. Empty voting is when you don't own the shares, but you buy them or you get them through some complicated derivative. And in my view, that's another practice that should be limited. And I would say, in general, I'm not for direct shareholder democracy, as some people are. I believe that the management of a company should be allowed to manage, and in general, if they're doing a good job, we should stay with them. And that really brings me to the fourth part of this talk, and that is why, in my view, if you want to lengthen people's time horizon in terms of corporate investments, the key is to change their executive compensation. I would say as you pay people, they will behave. Now, there has been a huge amount of effort put in the last 5 years and probably longer to say that if somebody gets a big bonus, that we should defer part of it, that we shouldn't pay it all out, we should defer it for a year or two. And I'm all in favor of that, because sometimes it turns out that they're being paid on a deal that's going to blow up. Sometimes it turns out that they're paid on numbers that are actually distorted or even misrepresented. And so I think that's a good thing. But the area that I feel has been neglected and is critical of this discussion is, what is the period, the measurement period, by which we measure performance when we give out either cash bonuses or stock grants? And I can tell you that in over 90% of the companies in the United States and in a lot of asset managers, the period is 1 year, the prior 1 year. You say, did this person do a great job, a good job, a bad job in the prior year? And if they did a good job, you give them a big bonus. If they did a bad job, give them a small bonus. Well, you're implicitly saying that the relevant time period is 1 year because that's what you're paying on. And I can assure you that everyone knows that. And at Fidelity and MFS, I was able to institute a 3-year rule. That is, we would look back every year for the last 3 years and see, did this person do well over the last 3 years? It was sort of a running 3 years. And it changed behavior hugely because then people wouldn't be just looking to see whether they could hit a home run in 1 year. They would actually have to have good performance over 3 years. And I came to a conclusion after going through lots and lots of comp sessions is for 1 year, people can get lucky. It's not that they're so smart or they're so skillful. They just happen to be in the right place in the right time. But I've rarely seen somebody over 3 years demonstrate outstanding performance because they were lucky. And that's the difference. What you're trying to reward is skill in management, not luck, not being in the right place. And that sort of skill can best be measured over 3 years. So in my mind, that's the most critical change that needs to be made, is to move from a 1 year to a 3 year. Now, some people would say you should move to 5 years or 10 years. I guess I found it really hard to move from 1 year to 3 years. And 5 years in this modern world is like an eternity. The other thing which is related to this is people get paid a lot now in stock options and in restricted shares. And we could discuss that at great length. If you're going to give out restricted shares, I want them to be performance-based. I want them to have reasonable vesting periods. I don't want them just to be what I call time-based. You shouldn't get a performance share just because you're still around after 3 years. But once you get these shares and they vest, most companies allow you to sell them right away. And that's a mistake. Because if you want people to have a long-term view, you shouldn't let them sell that stock right away. Now, there's a tax event that occurs when you get these restricted shares when they vest. So you should be able to sell 50% or maybe 60% to pay your taxes. But then you should be required to hold the rest of the shares for 3 years, 4 years, maybe till you retire. And the same thing holds with options. Almost every company I know has stock options that when they vest, you can exercise them and immediately sell the shares that you get on the option. And if you allow people to do that, you're almost inviting them to try to top the stock price. Because if they can push up the stock price for even a month, they can exercise and sell immediately. So in my view, again, if you're going to award people, and I think you should, with restricted shares and with stock options, and have a balance between those and cash, you should get some sort of system where these people are required to hold some portion of these shares that they get through these executive comp programs for several years or for retirement. And I can tell you that is not done in almost any company. The last point I want to make here is a little, how shall I say, mission that I've been on for the last 5 years is to stop getting companies to make quarterly projections of their next quarter's earnings. Like, next quarter, we project we're going to earn $2.32. Now, I'm on boards of companies where I'm having a real hard time getting them not to do that. And if you do that, you are focusing everybody on the quarter. And it seems a little naive to say, gee, the market is too oriented to quarterly performance when you are quoting and projecting your earnings for the next quarter to the penny. And guess what happens? If, God forbid, you're 1 penny off, the stock goes down. And that's because you as the CEO have actually said this. And my view is you should never say this. And if you have to say something, you should say over the next year, we're going to have earnings in this general range. But although I have been on this campaign for 5 years and many other people, the latest statistics I saw show that 74% of companies are still projecting their quarterly earnings. And there's been a recent study out of Harvard Business School where they looked at what people said on earnings calls, the CEOs, and what they found is when these CEOs talked a lot about quarterly earnings and about short-term things, guess what? They got an investor base who was very interested in quarterly earnings. So my conclusion is pretty straightforward. There is a legitimate concern about the fact that in some respects, the capital markets are moving people to shorter time horizons. And we surely want corporate executives to feel empowered to make good, long-term profitable decisions. But we need to recognize that ex ante, it's very hard to tell whether these are good decisions or bad decisions, and that we also have to entitle investors to look at people's track records, to look at the type of investment, and to make intelligent decisions about whether or not they back these or not. But if we try to remedy this by doing things like having 3-year and 5-year terms of corporate office, that seems to me a gross overkill. Instead, what we ought to concentrate on is changing the time frame for executive comp to lengthen it from 1 year to at least 3 years and hold the stock. And we should also encourage companies to stop having the CEO stand up and say, next quarter's earnings are going to be $2.32, because that is just exacerbating the worst aspects of short-termism, however you define it. So I'm going to stop there and going to take questions. One thing that Ron forgot to tell you that was my career as a stand-up improvisation comic. So I welcome questions, but I think they're going to ask you to go to this mic because they want to record it.
It seems like one of the hardest things is just there's an enormous amount of inertia, sticking with the existing system and having expectations baked in for this sort of thing. How do you honestly see a lot of these changes coming about? Is it through institutional investors taking action on this, or what do you propose, or what do you see?
Okay, so did everyone hear the question? So the question is, there's a lot of inertia in the current system. Well, I think we have different points here. One is we do have a group now of institutional investors led by the Canadian Pension Fund, CPP, which is trying to encourage long-termism. And by that, they mean that companies should not make quarterly earnings projections. Instead, companies ought to talk about things like, what's their long-term R&D efficiency ratio? What is their return on their long-term capital investments? In other words, the things that if you wanted to have people have confidence in your long-term decision, you would show the metrics that prove that you've done a pretty good job in the past. And hopefully, because these people hold a lot of shares, that they can start shifting companies to a different sort of earnings press release. Second of all is, I think it's really an educational effort vis-a-vis a lot of corporate directors. The surveys show that many corporate directors fear that if they don't tell you the next quarter's earnings, that the analysts will stop following them, that the trading volume will go down. And McKinsey did another study in which they looked at this very carefully, and all those things turn out not to be true. Basically, when you give Wall Street analysts a per share earnings projection, you're just playing into their own laziness. you're essentially saying, well, you can't figure it out, so I'll tell you the answer. But there's a huge risk in doing that, because if you're wrong, you're going to pay a big price. So partly it's an educational effort, especially for the middle-sized companies that fear this retribution. And third of all, in the end, and this is really what I feel is the most important thing, is corporate directors, the boards of directors, have to grasp and really embrace a different time frame for what their executive comp is and what they're doing. McKinsey did yet a third study in which they polled all these executive CEOs who said that they felt that not only were they being pressured for short-term earnings by investors, but also by their own boards. So the question is, what's going on with their boards? Executive comp, anyone who's done it, how many people have designed an executive comp system here? Good. So you know it's very complicated. Directors are the only ones who can do it well with the help of some technical people. You can't do this through shareholders. And so it's up to the directors to be good directors and really work out these systems. And I'm pleased to say I think directors are getting better, but they could get even better. And, well, Exxon is a company that has stopped making quarterly projections. And Fidelity is a company that pays people on the basis of 3-year performance. So those are two companies that have done it. But it's tough because, I say, on the earnings things, people, the middle-sized companies will say, well, Exxon can do it, but we can't do it. We'll get beaten up terribly in the market, even despite the evidence. And then companies that have somebody who's done very well for 1 year, they're all afraid that if they don't pay this person a huge bonus on the basis of 1 year, they'll leave. And that's happened, but I think you gotta have the courage to go to a 3-year system. Other questions? Yes?
Just back on your executive compensation.
Right.
Most executive comp packages are usually vesting over a certain period of time, whether it's 4 or 5 years, on the equity, not on the cash, but on the equity. Isn't that really what that's for, is to decrease the short-termism, to make sure that there is appropriate stock growth over that period of time so that package continues to grow?
Well, I would agree with you that having a spread out vesting period is a step in the right direction. But once these shares vest, let's assume you have a 3-year vesting period. So then the person isn't going to think they should just get a great deal in the first year. But what happens after the 3rd year? Then the stock has vested, and if, as soon as the stock vests, they sell all those shares, well, then it's no longer long-term from that point. And there are actually studies that show that when executives get to the point where they're only a year or 2 away from retirement, they change their behavior toward long-term investments and are less inclined to do it. So vesting is definitely, a long vesting period is definitely a step in the right direction. But this is sort of, I guess I would say, a complement to that.
Do you have a system where you get...
I think you have to go to the mic if you don't mind. Yeah, or speak up loudly and they'll hear it.
So if you have a system where you're issuing 5-year vesting securities every year...
Well, then that
they're constantly rolling over. Presumably you'd have less concern about the sale of a matured tranche.
Yes, I agree with you. If you had a staggered vesting period.
Ironically, eBay had such an arrangement, but nevertheless got whacked by Carlin.
For having that arrangement?
No, not for having that arrangement.
I think they got. I think if I'm not an expert on eBay, but I think at least at the beginning, Carl Icahn felt that they had to spin off PayPal and that they would get a better combination price, but he seems to have backed off. I don't know the details of it, but I don't think it was on the vesting system. Yes?
Something that you said did not have an effect on this, but as a reader of the newspaper, I'm sort of annoyed at this very flash trading. And I wonder whether 1/10% on every sale tax, that type of thing, would clamp this down to the point where it wouldn't be sort of an annoyance. The second question,
Sorry.
no, and you may not answer one or the other, is as a little
Try to answer them both.
as a little investor, it sort of feels to me as though the governance of companies doesn't make sense. Now, you're saying it's the right way to go by saying that nobody who owns stock, unless they're tremendous buyers or willing to eat poison pills or whatever, should be involved in managing. Anyway, those are the two.
Well, let me. Those are two good questions, and the second question, that just to frame it is, we have to decide whether we want centralized management or not, and it's not an all or nothing. My belief is in a good governance system, the shareholders have rights to decide certain issues, like whether they're going to merge or not, certain issues like election of directors, and they should have the right to accept or reject a tender offer or something like that if it comes around. But that's very different than saying that the shareholders should be involved in actually making these capital expenditure decisions, or that the shareholders should be involved in trying to design the very detailed executive comp system. Now, what we have since Dodd-Frank, we have an advisory vote on executive comp, and it's really an advisory vote on the executive comp report by the Compensation Committee. And I think if you look at the statistics, less than 3 or 4%, maybe in that area, of those advisory votes are negative. And those are playing a good role. They're playing a role, in my view, of policing the outer edges, policing the abuses, the executive comp systems that are really, in any reasonable person's view, much too generous or much too outrageous, or whatever the word you want to use. But I think that's very different than trying to set these systems. And so the shareholders elect the directors, and then the directors have the role of setting these executive comps, of picking the CEO and doing these things. And I think that in order to make our corporate governance system work, you need that sort of centralized management, but with these sort of safety valves. And so we need both. We need centralized management, but we need these safety valves. Now, on your first question, there are lots of reasons to be against high-frequency traders. And it's a very complicated subject. To the extent that high-frequency traders are getting information that other people don't, to the extent that they're paying, as some of the stock exchanges are being paid by them to give them preferential locations or access, those things seem to me wrong, and we ought to stop that. But the fact that some investors will be quicker and bigger than other investors will always be true. So we can't actually change that. Now, the idea of a transaction tax, a stock market transaction tax, has been floated a number of times. And there are sort of two levels of issues with it. A is there are lots of design issues about how you sort out high-frequency traders from somebody who's in a stable pension fund who buys and then sells a stock within a similar period. So there are lots of technical issues. But the main problem is this. Sweden put a transaction tax on its stock market about 20, maybe even 30 years ago. Within a week, there were very few trades in Sweden. And so these people can trade anywhere. It's a global marketplace. And if you could get Singapore and Hong Kong and Rio and all these other people to agree to have a transaction tax, then you could make it go. But if you don't do that, it will leave very quickly, because all these shares are traded now in many venues. Some people would say too many venues, but they're traded all over the place, And so you wind up taking trades that are made on a fairly regulated market, maybe not perfect, but reasonably regulated, and pushing them to the least regulated market. And so you got to think twice before you want to do that.
Well, I certainly like your ideas for how to solve this. What I'm concerned about is that it seems like there's a tremendous amount of momentum, even internally in corporations, around even the mechanics of this short-term reporting and focusing everybody on those short-term results all the way down the line. And so I'm wondering, the motivation for changing things, whether at the board level or inside these corporations, has to be that the results are going to be better, right, by making these changes. And how are we doing in terms of research that shows that or makes that case?
Well, it's a good question and difficult question. And so let's see, one part of the answer is the research shows that some people are really good at long-term investing and other people aren't very good at all. And so what we need to try to do is to discriminate between them. And it turns out not to be an easy thing, because you can be sure when Carly Fiorina was pushing the compact merger, she said it was the best thing since sliced bread, and it turned out to be a disaster. I've been on boards of corporations where a merger was pitched very hard as being important for the long-term growth of the strategy and everything. I couldn't understand it. I thought it was wrongly priced, etc. I was outvoted, and it turned out that I was right. So it's very difficult to do those things. But I think the key is this, is to start having metrics on that. So something like R&D efficiency. This is one of Mark Wiseman's from CPP, Canadian Pension Funds, proposals. R&D efficiency is a really important concept. Right now, we have drug companies that have spent $200 million a year on drug research for the last 10 years and essentially have nothing to show for it. The only drugs they have are drugs that they bought from small companies that then they essentially took through the last phase of clinical trials and they marketed them. Well, that's great, but that's a very different role. If a company is good at doing clinical trials and marketing, then why are they spending $200 or $300 million a year on drug research? So R&D efficiency is an important metric. Another important metric is, well, where are you putting your capital? I mean, essentially, every company that has free cash flow has to make a decision. Are you going to give that back to the shareholders today, or are you going to reinvest it so presumably you can make a better return by reinvesting it? So, I mean, in a sense, Apple was being asked that question. At that point, it probably had $130 billion of cash. Now, there's for Apple, a big tax problem that a lot of it's overseas, they can't bring it back, et cetera. But if they don't make a dividend to shareholders, they're saying essentially that we can do better with that $130 billion, every dollar of it, than we can give to shareholders. Now, personally, I doubt that. But the more you now see a lot of companies in the Fortune 100 trying to give back to their shareholders. Some of them are giving back 40% of free cash flow, some of it 50%. And that's the sort of statistic that we need to come to grips with. What percentage are you giving back of your free cash flow? And what are you doing with the other money? And how do we know that that's actually producing a better return? So what we need to do is to start having these different sorts of metrics being kept and being reported. Unfortunately, if you go to a press, I don't know, have you ever been at a quarterly earnings press conference? You don't hear anybody talking about these things. They're all talking about, well, what was the quarter and how it differed from the last quarter and whether it was a penny here or what was the currency valuation that changed things or these sorts of things. So it's a difficult decision to try to figure out who's good at long-term investing and who isn't. So we ought to start keeping metrics that at least, and promulgating them. And I think that this group led by Mark Wiseman is trying, and with a lot of institutions, is trying to go in that direction. But until we do that, it's hard. It's hard for people if they don't have those metrics. If we don't measure it, we probably won't be able to act upon it.
If Congress were to try to pass laws enforcing rules to do what you suggest, who would lobby against it?
Well, probably the nice thing about what I'm suggesting is you don't need Congress to pass laws. And these days, I would say it's very good to make any suggestion where Congress doesn't have to pass a law. Because you know what Congress is best at these days? Doing nothing. That's their expertise. And so I try to come up with proposals that don't need Congress to pass a law. So the sorts of things I'm talking about, which is to have a longer period for measuring executive performance. You don't need a law to do that. What you need is boards of directors to take that position. You don't need a law to tell some CEO that if he or she says we're going to make $2.32 next quarter, that they're focusing people on the short term. So what I'm saying is that's not the way it's going to change. The way it's going to...
Without the law, who is against it now?
Oh, well, the answer is that partly it's inertia and partly people are afraid. And I think what it's involved is a combination of institutional shareholders in these groups like the Canadian group and boards of directors just taking a different viewpoint. But I don't think there's really much that Congress could do about this.
Forget Congress, just who's against it?
Who's against it? Well, I think people who are against it, look, say, the 74% of CEOs who are still projecting quarterly earnings think they're against it because they're afraid that if they don't say what their next quarter's earnings are going to be, that their stock is going to go down and their volume goes down. We know that from surveys. But we also know from statistical evidence that it's not true. So we have to educate them. They fear. They're fearful, and we got to overcome that fear. Yes?
Hi. So I'm a little bit worried. I love the idea of metrics. I think they're important. Also, having spent a bunch of time in drug discovery and development, Biogen IDEC was in my past, so I know Carl Icahn pretty well as well. This issue of return on R&D, it's not even the same across companies in the same sector. You know, you've got different metrics that come into play, and you could use the same argument around CEO pay ratio, something else that we didn't ask for and we're now on the receiving end of. And so you put these metrics out there. There's a question somewhere in here. And how do you actually get the investors to stop and be thoughtful enough to understand the context of it?
Well, I wouldn't be, it's a good question. I wouldn't be in favor of some government-defined measure of research R&D efficiency because, as you say, it may differ from company to company. But right now, most companies don't make any attempt to tell us how much they've spent on research and what they've gotten from it. So I think a good starting point would be to let the company tell us what they have spent and what they think they got out of it. I remember there's a company in Cambridge called Millennium. You probably know it. It was sold for $8 or $9 billion. It never had one product, not one, after 20 years that ever came out of its lab. None, zero. But it was lucky enough to buy two or three products that were halfway developed from small biotech companies, and that's what it was sold on. So my view is, then let them buy some more. Just don't let them spend the money, on all this research because the evidence isn't there. Yes?
Hi. Oftentimes when companies have long-term performance-based incentives, they're linked to key performance indicators such as EPS growth, revenue growth, return on invested capital, or total shareholder return. So I guess my question is, if you were a shareholder, which KPI would you most want to see in a company that you were invested in for CEO?
Well, KPIs are key performance indicators, very, very trendy thing these days. The answer I would like to see is a mixture. And one way to think about it is if a company doesn't continue to grow its revenues, that's the potential for value creation. And second of all, it can grow its revenue, but it might not grow its earnings because it's not doing a good job of managing its costs. And third of all, we all know that in any particular year or 2 years, even if a company is doing well on growing its revenues and earnings, that might not yet be reflected in their stock price. Over 5 years, it will be reflected, but if you're in a year like 2008, all the stock markets are going down. So therefore, I would be in favor of a mixture of indicators that include revenue growth, earnings growth per share, that include stock price relative to peers, and fourth of all, total shareholder return, which includes dividends as well. And I think if you try to lay too much of executive comp on any one of them, you've probably made a mistake, because you want to do all four of them. And stock options are really good about capturing stock price. And that's why if you do restricted shares with performance conditions, I'm in favor of using those to orient more toward revenues, operating profits, and these sorts of things, because you don't get them through stock options. Yes?
Most ownership now of large companies doesn't reside with individual shareholders, but is controlled by intermediaries like your former employers, Fidelity, MFS, Vanguard, Capital Group, et cetera.
Correct.
So if we look at the top, if we look at 70% of shareholders,
I agree.
those are the names we're going to see. Number one is, how do you think the boards respond to the intermediaries? And number two, how have the mutual fund companies responded to your suggestions?
Well, it's good. These are good questions. So boards respond to intermediaries in the sense that boards are pretty sensitive to how their big shareholders feel and how they vote on various things. And most companies go around and essentially visit their big shareholders and have presentations, and then analysts ask them questions. And the ones I've been to are pretty interactive and pretty hard-hitting and pretty fruitful in terms of that. I would say that there's probably more progress in going to 3 years on the asset management side for performance measurement period than on the corporate side, but we could go a lot better. And Vanguard is at 3 years, MFS is at 3 years, Fidelity is at 3 years. But I think the smaller companies are afraid that if they don't pay, a guy or a woman has a good year, they don't pay them, they'll be out of there. And so you really have to resist that urge, because that's what it's about. And I think that institutional investors try to be very diligent about voting their proxies, and when there is a activist hedge fund, they try to evaluate the proposals. They try to evaluate these various proposals. So I think the bigger ones are very good at it. I think there are two issues on the institutional side. One is smaller ones who don't either have the resources or are worried about losing a star. And then you have the whole world of index funds. So that's about 15 to 20% of the holdings. So index funds is sort of like a double-edged sword. On the one hand, you could argue they have the biggest interest in the whole system getting better because they own the whole system. On the other hand, they don't really have that big an interest in any particular company or particular situation, and most of them don't have analysts who cover the particular company. And some of them are so low cost that they basically follow the recommendations of the proxy advisors or people like that, because they don't want to spend the time or energy to do it. And so I think one of the things we have to do is, since index funds are big holders, we need to have them be diligent about exercising their voting and their shares. Yes?
On the index fund, so figure we can run a fairly large index fund with about 4 people.
Right.
To run it. But it seems to me it's also the case that if we look at the large index funds, they're, because of the scale problem, they're lodged in large asset managers.
Correct.
Are the index fund managers voting those shares, or are the active portfolio managers voting those shares? Because you could imagine off the top of one's head, if you're buying the index, one way to match the voting to the index concept is take that for BlackRock. They'll simply vote the index share that is near to the way they're voting their active position.
Yeah.
But you don't get ISS.
I think the answer is it depends on the issue. And basically, on governance type issues, say things like staggered boards or these sorts of issues, rights to call meetings, they tend to be handled by a centralized group in these big managers that votes the same for everybody. But when an economic issue comes up, where you have an activist hedge funds, then sometimes the portfolio managers get involved, and sometimes you actually see different portfolio managers in their place taking different positions. But it depends on the issue. It depends a lot on the issue. And you're right to say that since the index funds, a lot of the big index funds are within big complexes, or at least there are the resources there that are already that can be piggybacked on. But still, I don't think we can get away from the fact that there are index funds, there are ETFs in which not a lot of resources are being put into this. Yes.
Hi, my question is kind of a longer range thought experiment, I guess, which would be if, say, the majority of companies move towards long-termism and were successful at it, how do you think that would, some years out, affect society, the economy, employment, employment churn? Would there be some unintended consequences like a reduction of entrepreneurialism, or how do you see this potentially playing out?
Well, I don't think we have any. I don't think there's actually much of a risk of all companies going toward long-termism. What we want is we want the companies that know how to do it to go to long-termism, the ones that don't. So part of this thing is we want to encourage new companies. We want to encourage entrepreneurism. So we're back to the sort of basic issue is that if people who were good at building companies concentrated on long-termism, then we'd produce more jobs and lots of things. But if people who weren't very good were long-termism, well, then they're just going to waste a lot of money on, say, drug research doesn't come about, and they might actually then politically push to try to stop entrepreneurs and things like that. So we can't get away from the basic fact is that some people are good at making long-term investments and other people aren't, and so we just have to have a system that allows us to distinguish between them. I think we have time for, you already asked a question. Anyone else want to ask a question who hasn't asked the question? Yes. Well, these two questions, you and then I want to honor our commitment to 7 p.m.
So I liked a lot of your ideas, and the one question I'd like to ask relates to the corporate governance subset of the comments you made, and in particular things like term of office for directors, staggered boards, poison pills, and things like that. Would you have a different view on the design of those rules at the point of IPO as opposed to changes in those rules post-IPO? It strikes me that a lot of the concern expressed about corporate governance rules seem moot at the point of IPO because whoever is designing those rules pays fully for the consequence of the set of rules they choose by virtue of the terms that they can raise capital on. And it seems to me we often don't distinguish between the rules at IPO versus changing the rules post-IPO, which strikes me as an important distinction.
Well, I agree with you that to the extent that you have governance rules that are built in when people buy the stock and it trades, so then they either accept them or they don't. But 3 points. One is poison pills are never in a charter stuff, and poison pills now are as a matter of common law. The directors can adopt them if they meet some pretty reasonable test. And I'm not against poison pills. It's the question is how they're used. Poison pills can be used to have an auction to increase value. Poison pills can be used to protect somebody against a cheap shot offer, etc. But then on the other hand, you have poison pills that are triggered at 10% and poison pills where it go on for 2 or 3 years. So again, it's a question of how directors use them. And then third is, even if you start off with a system where, and this is interesting, where now the Chinese companies who can't on the Hong Kong exchange go IPO and have a few people control it, they go to New York and they can have a few people control. Well, there's nothing wrong with it because people are going to buy, presumably, the stock. The question then comes down to what's the fiduciary duty of these people or in control to the minority shareholders. We're all used to thinking of the corporate governance problem here as we have a series of lots of scattered shareholders. Can we hold management accountable? But where you have a control shareholder who controls all the marbles, you can be sure the CEO is responsive to the control shareholders. The question then is the minority being treated fairly? And what we've seen in Chinese companies is that people become more and more cynical about how the minority is going to be treated. Now, partly that's reflected in the price originally, but partly it depends on how they're actually treated as the situation goes. And so I would generally agree with you, but there are, I think still, even if you have control and the shareholders have accepted that, the question is, what is their implicit assumption about whether they're going to be treated fairly? And if somebody like Jack Ma decides that he takes some very valuable subsidiary and he somehow does some abracadabra and he winds up owning it and other people don't. Yeah, okay. But I'm just saying to you is, when you say the people accepted at IPO, the question, what's the it? They do accept that this person is control, but they probably also expect not to be treated really unfairly. And so that's really what I would say. Last question.
Yeah, just to your earlier point about, we talked about regulation instead of business average, but
Well, I don't say that as across the board, but in terms of things like executive comp, I don't think having a new regulation is the way to go.
No, but my point more being, we live in a world now, where companies either take themselves private in order to focus on longer term growth, such as Dell, or delay it as long as possible, such as Facebook. My question would be just more, if you had to pick and choose, I think maybe the top things you'd like to see at least eliminated as far as requirements for reporting and disclosure, that might possibly improve the situation publicly.
Yeah, I guess, I'm of the somewhat different view that's implicit is, I don't think that that what's keeping people from going public is having to make annual reports or quarterly disclosures. I don't think that's what's keeping them from doing it. I think they can go public and have control, and so in a sense, as you say, they don't have to, they can build a different expectation, they can do all these things. So the sorts of things that happened in what's called the Jobs Act, where people were allowed, for instance, not to have the internal controls provision of SOX. Now there's a provision that costs a lot, and I guess having been on audit committees and stuff, I'm not sure we need quite an onerous provision like that, and it's perfectly reasonable. And we also, second of all, we have the auditors have to put out a report on the internal controls. Interestingly, in Canada, there's an obligation to have internal controls, but there's no auditor report. So I'd like to see an empirical analysis of whether that really made a difference. So there are lots of what I would call unnecessary costs for going public, but I don't think they include the disclosures in a prospectus or having to make quarterly reports. They include a lot of other crazy things. Congress just passed this conflicts mineral thing that applies to all public companies, where you have to trace these, way back into your supply line, whether something came from the Congo or not. So those are the sorts of things that really do this. But remember, the beauty of the disclosure system is, as you say, you can do anything as long as you say, this is what I'm doing. I'm doing it. This is what I'm doing. This is the expectation. And so I don't think that's what really prevents companies from doing this. The other thing is leverage. When you see these going private transactions, they're highly leveraged, and sometimes they work out and sometimes they don't. And in a public company, you're going to get a rating. In a private company, you don't have that sort of rating. So I think the notion that people have said, that they have argued that because of these rules, you don't have IPOs. But it turns out that the pendulum of IPOs and the number of IPOs don't seem to be that correlated to exactly what the rules are. usually is when the market's good for IPOs, people do them. And those guys who did private equity, they come back and do them.